Welcome everyone to the latest JMI Wealth video update. Now we're recording this in early April, so it's autumn, and we've successfully put away the first quarter of 2024. And I did want to talk through the quarterly outcomes that we've seen in various markets, because it's been quite a pleasing quarter for portfolio performances, and that's extended right across both fixed interest markets and share markets. Now, the all-important US share market has had the strongest start to the year since 2019. And if I look at the S&P 500 index, returns in New Zealand dollar terms were a remarkable 17%. That's courtesy of a double-digit rally in the index in US dollar terms and a much weaker New Zealand dollar over that same period. Now, the reasons why the US market is buoyant at the moment have been quite well publicised. I mean, the US economy has proven to be quite resilient, and that's despite tighter monetary conditions, despite slowing growth, and actually despite some skepticism, the much talked about soft landing keeps sitting out there as a real possibility. But in other words, yes, slowing growth, but at the same time, no real slump in the labour market and generally moderating inflation. Now, the most recent release of what is the bellwether US employment data, and that's what we call the US non-farm payrolls. The US labour market added 303,000 jobs in March. Now, that's much stronger than the 200,000 that were expected, and it's adding those jobs at the moment without a worrying acceleration in wage inflation. And we can see that growth in average hourly earnings slowed on a year-on-year basis to 4.1%. Now, a year ago, the same measure of wage inflation was running at almost 6%. So look, this result was cheered by the share market, but if this sort of strength continues, it makes the Federal Reserve job a little harder, and it potentially delays the introduction of interest rate cuts. And at the moment, it's pretty much a 50-50 bet whether interest rate relief will come in the US in June or be delayed a little bit until the US central bank is really confident that broader inflation will keep declining and will end up inside their target range. So look, while there may be a bit of debate around the timing of a lower Fed funds rate, there's a broad agreement that interest rates at some point will start to fall. There's also in the US at the moment plenty of optimism around the AI boom, and there was global attention on that standout NVIDIA result for the last quarter of 2023. But it goes beyond that. Dell Technologies also delivered a strong result. Now, its share price surged 31% following the release of its result and evidence of rising demand for its AI servers. But not only that, but also their positive outlook on that demand. And the last point I want to make about the US market is what we refer to as breadth, market breadth. Last year, the story was all about the Magnificent Seven, so the mega cap companies and the tremendous share price leaps that we'd seen in those stocks. Well, the Magnificent Seven is now more sort of accurately described as the Fab Four or the Fab Five, because a couple of them aren't doing so well. Apple and Tesla have stalled so far this year. Tesla in particular coming under some share price pressure, notwithstanding the fact that the share price rallied more than 100% last year. Look, but it's important to remember that there are 493 other companies in the S&P 500, and we would expect to see more focus on these companies as 2024 plays out. And I also note that the US small cap index, it was up almost 10% in the March quarter. So we're seeing those share price gains now right across the spectrum. And also a mention of the New Zealand share market. Look, it's been a real underperformer over the last couple of years as those sort of big tech companies have lifted the broader US indices. But the NZX 50 index did lift 3.3% in March. Now, while the 12-month performance number is still well behind other markets, it was encouraging to see that gain over the month. And I do want to sort of cast an eye a little wider as well, because look, the US share market does now constitute over 60% of major global indices, but other markets have also warranted some attention. European markets enjoyed a solid quarter. The real star performer over the last year has been the Japanese share market. I mean, over the last 12 months, it's delivered almost a 47% gain. And if we look at the valuation story, market valuations do look more attractive, firstly outside of the US mega cap space, but also outside of the US share market in general. And just sort of turning our attention to interest rates and the economy, one of the key trends that we can see at the moment is the squeeze on discretionary spending is real and it's continuing. This is really evident in the retail sector. Look, we know that spending locally is soft. We know that spending on a per capita basis is going backwards, and this is making it hard work for companies in the retail sector. We see this right around the world. Locally, the recent company reporting season showed that companies like The Warehouse and Kathmandu, they've really suffered from this pressure on the discretionary dollar. So you've got this squeeze of the higher cost of living, rising costs for things like rates and insurances. You couple that with the ongoing impact of the increase that we've seen in mortgage rates, and that's what's putting the squeeze on discretionary spending. When we think about the outlook for interest rates, though, it's evident that right around the world, inflation is moderating. The big question, though, is whether or not the wins that we've seen in the battle against inflation so far will now start to be harder to come by. Financial markets, though, they're always looking to second guess the central banks. The local money market is speculating that we could see a cut in the official cash rate here in New Zealand by August. That would lead to lower wholesale interest rates. Look, it's not impossible, but our view is that the Reserve Bank of New Zealand won't be in a hurry to begin the process of reducing or dropping those monetary policy levers. Look, we still think there's a good chance we'll see the official cash rate lower this year, but towards the end of the year is more likely. Now, last month I said that at a high level we remain positive on investment portfolio exposure to global shares. Now, at the moment, we're having pretty robust conversations over Australasian shares and whether or not the tide will turn in favour of Australasia relative to global exposure. And that debate, I can assure you, is ongoing. But we're also reviewing the composition of our global exposure, thinking about the attractiveness of markets outside the US. And I've said it before, but interest rates are now delivering appealing returns, and that altogether bodes well for portfolio returns over 2024. So markets now are a bit more settled. And what better time than now to review your own investment and financial goals? And look, there's a real benefit including an experienced financial advisor in those conversations. It's a smart move, it's a prudent move, and we'd love to help you with any of those investment questions or needs that you may have. So look, don't hesitate to reach out and contact us. You can look us up as ever on jmiwealth.co.nz or on Facebook or on LinkedIn. We'd love to hear from you.